All right, let's jump right into this explainer. Today, we are putting aerospace giant Boeing through the ultimate financial valuation gauntlet. We're going to take the legendary investing frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham, mix in some hardcore discounted cash flow modeling from our source materials, and see exactly what's under the hood of this stock. Here's the game plan. We'll start with a quick snapshot of where Boeing stands today, then run it through the Buffett lens, the Lynch lens, and the Graham lens. After that, we'll dive into some DCF and alternative models before wrapping it all up with a final synthesized verdict. Section 1. A snapshot of the Boeing company. So looking at the Q1 2026 numbers, you've got the commercial airplane segment bringing in $9.2 billion. That's off 143 commercial deliveries, by the way. Add in defense, space, and security at $3.2 billion and global services at $9.8 billion. And overall, total revenue hit $22.2 billion. That is a solid 14% jump year over year. The top line is clearly growing, and they even posted a positive operating income of $448 million. That's a 2% operating margin, not too shabby. But, here is the massive paradox right at the heart of Boeing today. On one hand, they're sitting on a mind-blowing $695 billion backlog. We're talking over 6,100 commercial airplanes, which basically guarantees future demand. But on the flip side, they are crushed under a staggering $50.8 billion debt load, plus a Q1 earnings per share loss of 11 cents. So they've got the customers locked in, but they are seriously struggling with execution right now. And as investors, the big question is whether that backlog is just a mirage or an absolute goldmine waiting to be tapped. Keeping all of that in mind, let's run this through our first legendary framework. Would the Oracle of Omaha, Warren Buffett, see any value in this aerospace duopoly right now? Section 2. The Warren Buffett lens. Now, a completely crucial metric for Buffett is owner earnings, which we proxy here with free cash flow. In Q1 of 2026, Boeing's free cash flow was negative $1.5 billion. Yeah, they are burning through cash. However, CEO Kelly Ortberg recently pointed out that demand is so incredibly high, they actually see a path to generating a positive $3 billion in free cash flow by the end of 2026 as production finally stabilizes. So let's literally grade Boeing on the Buffett scorecard. Economic moat? Pass, for sure. It's a massive global duopoly with Airbus. But after that, well, things kind of fall apart. Earnings consistency? Fail, thanks to heavy recent losses. Return on equity? Fail again. It's currently sitting lower than their weighted average cost of capital, which is about 8%. Debt levels? Massive fail at $50.8 billion. Look, despite the undeniable moat, Buffett strictly demands a margin of safety. With this heavily leveraged balance sheet, he'd almost certainly wait on the sidelines until that $3 billion in free cash flow actually shows up. All right, so Buffett's out for now, but how does a growth at a reasonable price legend view a company in this kind of messy transition? Section 3. The Peter Lynch lens. Peter Lynch loves to categorize stocks, right? And he would instantly peg Boeing as a classic turnaround stock. It's been hammered by cyclical and operational disasters, but there is a clear path to recovery. On top of that, he probably see elements of an asset play here too, specifically because of that wild $695 billion order backlog. That is, of course, assuming the company can survive its impending debt restructuring. To calculate Lynch's absolute favorite metric, the PEG ratio, we actually have to make a bit of an assumption since Boeing currently has negative earnings. If we use a proxy forward PEG ratio, basing it on 2027 normalized earnings expectations and that current 14% revenue growth rate, we get a slightly elevated 1.78. Now, Lynch typically wants a PEG of 1.0 or lower for a true bargain. You combine that 1.78 with their heavily leveraged balance sheet, and assuming neutral insider buying to fill a data gap we have in our sources, Lynch would likely label Boeing a pretty risky hold. He'd definitely want to monitor the turnaround before jumping in. Which brings us to the ultimate, strictest test. Is there any margin of safety here for Benjamin Graham, the literal father of value investing and Buffett's mentor? Section 4. The Benjamin Graham lens. Put Boeing under the Graham microscope and the brutal reality of a turnaround stock is on full display. Sure, Boeing passes the adequate size test with a $178.5 billion market cap, but guys, it fails literally almost every single other point on his defensive checklist. Strong financials? Fail. That debt completely dwarfs their $20.9 billion cash pile. Earning stability? Fail. They posted a net loss. Dividends? Suspended. Modest valuation? Well, you can't even calculate it with negative EPS. And honestly, it gets even worse when we run Graham's famous intrinsic value formula. When you plug in Boeing's negative 11-cent Q1 EPS and factor in a negative book value per share due to all those massive recent deficits, the math just breaks. The formula is mathematically undefined. Graham would probably be rolling in his grave looking at this balance sheet. He demands a high margin of safety and absolutely wouldn't touch this stock at any price today. It's a hard avoid. Section 5. DCF and Alternative Models. Okay, let's leave the historical legends behind for a minute and look at the raw mathematical future. We need to project out those future cash flows using discounted cash flow and alternative relative peer valuations. This is where the picture gets really fascinating. A base case DCF from the Cross Fund, assuming an 8% weighted average cost of capital and conservative terminal growth, puts Boeing's fair value at $199.27 per share, meaning it's actually a bit overvalued today. But wait, relative valuation based on forward multiples places fair value much higher, between $265 and $319. And then there's the 2030 bull case model. Projecting massive margin inflection, that model targets an astronomical $3,240 per share. Crazy, right? So we have this massive tug of war going on between the bear and bull cases. The bear case DCF of $199 firmly accounts for current operational realities, things like FAA delays pushing the 777X back to 2027, and some really tough labor union negotiations. The relative bull case of $319, though, entirely hinges on management stabilizing the 737 MAX production at 47 planes a month this summer and rapidly expanding those operating margins. Section 6. Synthesis and Final Verdict. All right, time to bring it all home. We've evaluated the moats, run the PEG ratios, crunched the intrinsic value formulas, and discounted the cash flows. Synthesizing all these insights, the old-school value investing frameworks basically demand patience. Buffett says wait for the free cash flow, Lynch says hold and monitor the turnaround, Graham says avoid it like the plague. Meanwhile, the forward-looking DCF valuation suggests you only hit buy if the price dips below $200. It is a stock precariously balanced between current, very real financial distress and the promise of massive future cash flows. So what's the bottom line here? What should you take away? Well, the entire investment thesis rests on management's ability to execute. The strengths are undeniable. You've got an unrivaled global duopoly, a $695 billion backlog, and a return to top-line growth. But man, the risks are intense. They've got a $50.8 billion debt maturity schedule hanging over them, with over $8 billion due in 2026 alone. Throw in the 777X certification delays and labor union tensions, and literally any further systemic disruption could be devastating. Therefore, our synthesized final verdict for Boeing is a hold at its current price of $226.49. Based on that blended DCF and strict value investing principles, we'd suggest a buy only if the stock dips below that $199 intrinsic value mark. On the flip side, it becomes a sell if it rallies past $230 without actually proving that their $3 billion free cash flow target is structurally real and sustainable. The math clearly shows the runway is cleared for a legendary comeback. But as always in aerospace, execution is absolutely everything. So here's the billion-dollar question to leave you with. Will that $695 billion backlog translate into the financial turnaround of the decade? Or are these operational bottlenecks going to ground the stock forever? That is exactly what you need to be watching. Thanks for hanging out with me for this explainer, and I'll see you next time.